Good day, everyone. How's it going? I am amazed that this is working. We've got some feedback. So I think what I have to do is drop that. There we go. Hey guys, how's it going? Just going to wait a couple more minutes just to give people a chance to rock up. What a week to start though, eh? This is, first of all, before I start waffling on, can I just get a sound check from people in chat? So if you can hear me right, if I'm like blowing your eardrums out, please let me know. If it's good, then please let me know. Sweet. Yeah, what a week. Crikey. I have never live streamed before. This is the first time I've ever done it. And of all the weeks to start a live stream on stocks and shares, I don't think I could have timed this any better. Awesome. Okay, we sound good. So yeah, I basically have been thinking about live streaming for a while, and a lot of people, friends of mine, have been saying, look, you really should get on the old live streaming boat, and it just never felt like the right time. And I've been doing the podcast for getting on for 2 years now, and it just never felt quite right. I felt like I was in the right place doing the podcast, and then recently, the last few weeks, it's just felt like I've just had this buzz, this urge to start doing live streaming, and yeah, it just felt like the right time, you know. So I started researching into how it works and how you do it, and I've got the equipment, and hopefully we are working. Thank you everyone in the chat for letting me know that you can hear me. That's pretty cool. Yeah, what a week. What a start. It's going to be awesome. I've got loads of stuff I want to talk about today. We'll go into it. But yeah, it's also awesome to bring all these people together because, like I say, we've been doing the podcast for 2 years and we've been getting 6,000 downloads a month. And to be able to bring those people together in a more kind of community-driven form, I think is awesome. So I'm proper chuffed about that. I'm proper chuffed that we can bring people together, that you guys could be chatting. We've also got Discord. If you're not in it already, there is a link on my YouTube channel. But you can also go to my website, chrischillingworth.com. And in the navigational bar along the top, you'll see a link to the Discord, and you can join that way. And that is where we're going to be chatting kind of off stream. So after the stream, we'll be in there. Throughout the week, we're going to be in there talking about the next show that's coming up and stuff like that. And as we go through today's show, I'm going to bring up some bits and pieces that's going to invite you in to kind of participate a little bit. And the Discord will be where we do a lot of that off stream, if that makes sense. So I've got my coffee. I hope everyone's managed to have a chance to get their brews sorted out. And we will get started, I think. How many people we got in here? This does tell me 46 at the moment. 46. That's mental. I said to someone yesterday, if we get 5 people, I'll consider that a success. So 46, I think that wins. I think that's all right. So yeah, awesome. 46 people for the first stream. I was doing some research on streaming, and the amount of people that try and do live streaming and they spend years streaming and they only get like 1 view. And I thought, what am I letting myself in for here? This is going to be painful. If I'm just sitting here all night talking about stuff to one person, it's going to be tough. So for this to be, yeah, first stream, 46 people, I'm well chuffed with that. So awesome. We just hit 8,000 subscribers on the YouTube channel as well, which is a milestone in itself. So thank you to everyone who has subscribed. Just in the last couple of days, I think we've had about 20 people join up on the subscriptions. So that's awesome. Thank you so much. So I think it's time to get started, and I wanted to talk about this chart here. Hopefully you can see it and my big noggin is not in the way. Let me just check that. Chat's kind of in the way, isn't it? What can we do about that? We can bring that there. I'm going to try and be mindful of this as I go because I'm new to streaming, never done this before. I wanted chat to be on screen, but at the same time, obviously trying to keep enough screen real estate free for us to be able to look at what we want to look at. So this will be a bit of an art for me. I'll be trying to balance it. If anything is like not working, you can't hear me, if the chat's in the way, shout in the chat, let me know, and I'll try and adjust it as we go. So let me just bring this down a smidge. I should probably do that in the streaming software, to be fair, but right. So the markets. Where do we start with the markets? I wanted to start with the S&P 500 because still running at the moment. I think it's still going at the moment. Just gone 8 o'clock, but it may have stopped. But anyway. There is a lot of press right now talking about how the markets are in a mess and what Donald Trump has done has caused pure chaos. I personally think that this is a fantastic opportunity. I'm slightly, I guess, contrarian on that view in so much that it's not a popular belief, but I genuinely believe it. And I want to explain why. Because if we look at the S&P 500 right in front of you here, what I've done is I've created a chart that shows every one of these candlesticks is a year's worth of price movements. Okay, so this goes all the way back to the 60s, but we're not really too fussed about, you know, pre-2000. I want to look at the big crashes that have happened. So we've got 2000, the dot-com bubble crash. As you can see, we've got 3 consecutive years here of the S&P 500 falling in value. Year 2000, year 2001, and 2002. The next crash we had was 2008. Then we had a crash in 2020, which it would be this bar here. But what happened was it's a green candlestick because it came all the way down and then moved all the way back up by the end of the year, right? So it actually gained in the year. So we're not quite seeing that on this particular chart. But then we've got the bear market of 2022, and then we've got what we are going through right now. And again, this is only the S&P 500. This is only US stocks, but it's pretty much the same across the global markets. And what I wanted to show you guys was that every single one of these crashes has recovered. Every single one. In fact, you can go all the way back to as early as records will go at looking at these charts, and you can look at every single pivotal crash that has happened, and we can see visually from these charts that the market's always recovered. And I want you to remember that when you are watching people on YouTube, people on X, people on Instagram saying this is the end. And I've seen videos that literally say this is the end. It's like, it's not. It's really not the end. You know, I would argue that the banking system potentially failing, everyone thinking that the banking system was going to fail, was bigger than this. I would argue that the dot-com crash was bigger than this. That's not to put, you know, too much of a dampener on what Donald Trump has actually done. It is going to create massive waves, and I totally appreciate that. But let me put it another way. if you don't think the markets are going to recover, if you think this is it, you're banking, you're assuming that there is never going to be another bull market in history. I don't believe that. I don't believe that is the case. And as a result, what this means is that for those with capital to put to work, and I appreciate not everybody has capital to put to work, but for those that do, this is an opportunity for people to grow, to grow their portfolios, to do something quite magical and exciting. And another way that I tend to look at this is many of us were buying stocks in the first 3 months of this year, and we're happily doing so. So I mean, if we were happily buying stocks over the first 3 months of this year and all of last year and whatever, we should be more than happy to buy now, because stocks have become cheaper. It's a great time to buy. It's a great time to get involved. Yeah, absolutely. And this is something I've got to get used to, by the way, is keeping an eye on chat and engaging with you guys, because I'm used to podcasting. I don't get the opportunity to converse with people when I'm podcasting. It's just me and nothing else. I'm in this little bubble. I'm just chatting about stuff. So forgive me if I don't see your messages come through. I'll try and remember to jump in. But yeah, it's I'm excited. I am genuinely excited about this. I'm not saying that we're at the bottom. I'm not saying, you know, that it can't go lower, but and yes, there was a mini recovery earlier today. I've seen this. I was trading and investing back in 2000, and I saw the markets, you know, jump up a little bit and then come down further and then jump up a little bit. And so I'm conscious of the fact that no one knows if we've hit the bottom. And the thing is with picking and trying to identify the bottom is that you don't know when you're in the bottom, if that makes sense. So you only can tell this kind of when you look over your shoulder at the past. Once it's been and gone, you can look over your shoulder, look at the historical charts and go, okay, we did hit the bottom at that point. But when you're in it, you don't know. And I am not an advocate of trying to predict it anyway. I am a massive believer and proponent of only focusing on the things that you can control, and not really being that interested in trying to predict where the bottom is, because I'm going to buy on the way down, I'm going to buy at the bottom, I'm going to buy on the way back up. And this is something that I've been saying to our clients and members in the Discord, people in the Discord. Only today I was saying, you know, I will be buying at £5, at £4, at £3 on the way down, and I'll buy at £4, £5 and £6 on the way up. It's no difference to me. It's the same price. Whether we're on the way down or on the way up, I'm more than happy to do that. And I think it's what was it saying? You could have, I can't even read what that says. But yeah, I want to show you some things anyway today that I think are quite cool, and I think will give you an insight, and you may or may not agree with what you think or what I think, but that's totally cool. So where are we now? We're at 5025. So for this to officially be a bear market, and I say officially, there's no actual official guidance on it, but generally speaking, if you look online, most people say that the market has to drop by 20% for it to be officially a bear market. I think we're going to get there. We were there at some point today, and obviously we bounced back up a little bit now. But we were, the high of the S&P 500 is or was at I can't remember what it was now. Will show me here. The high was 6147. We're now at 5020. So we're not quite 20% down, but we were at one point today. We bounced back up a little bit now. So does that constitute a bear market? I think we're pretty safe to say it probably is, but we'll see. But I have been raving on and on for a while now, especially to my clients, especially in the Discord, but also on the podcast about the Buffett indicator. And the Buffett indicator is this chart right here. Essentially, it is a historical chart that shows essentially it compares the stock market valuation of businesses as compared to their underlying actual value, the GDP ratio, essentially. And it basically tries to look at, are companies overpriced on the market compared to what they're actually producing as a business and making in terms of revenue and sales. And the US markets have been overvalued by amount of about, at one point it was about 250%. Because of this decline now, we're actually down to about 170% according to the BuffettIndicator.net website. We are still significantly overpriced, and if we look at this chart here, you can see we've come down, but we're not down enough on this chart. We're trying to look to see if there's a better version of this, but no, there's not. But that I do actually have another. Do I still have it? Here we go. So this is old now. This is December 31st. Hopefully you can see this. Let me just check you can. Yeah, cool. So December 31st was when this was last updated. But I wanted to show you this one because it shows you the +1 standard deviation, the +2 standard deviation. So you can see here that the value, the 211% ratio of market value to GDP. This is where the price, the stock market valuation of US stocks is grossly overpricing the whole market, essentially. And it's not sustainable. And where we've seen the prices reach this point in the past, we've seen a massive decline come straight afterwards. And I don't think that's a coincidence. We see it here. We see it again in 2022. It came down and it's gone back up again, and now it's coming down again. And it's because it's unsustainable. It cannot continue to go that way. And I like to keep an eye on the Buffett indicator for that particular reason. And I think we're still not in the territory at this stage where prices are fair valued or even modestly overvalued. We're still significantly overvalued on US stocks right now. So I think there is room for this to continue to go even further, even lower. I'm not saying that the Buffett indicator will dictate whether it does or doesn't. I don't think that's necessarily correlated. But I think there is room for this to go further. If we were still looking at US stocks, a large degree of them are still massively overpriced. And I think that's something that we have to bear in mind. I like this chart here. I wanted to show this chart here. This is bear markets throughout history and their recoveries. What I wanted to kind of point towards, these are all the different downturns that we've seen in the stock market. And what I wanted to point towards was these are the downturns, is how many months those downturns went on for, and what percentage of decline that we saw. So the biggest one was 2007, 2008, 14 months where the markets declined by about 52%. And then, as you see on the right-hand side here, we've got a breakdown of the different recoveries. And yeah, I mean, Alex Cooper, Chris called Rolls-Royce as a dead duck, and now it's done X8. Okay. So, yeah, okay. So Rolls-Royce, when we looked at Rolls-Royce, in fact, we're looking at Rolls-Royce today. So let's bring them up. When we looked at Rolls-Royce, this was back in 2020, right? This was a company that back then were doing incredibly poorly. Now, I am not in the business of predicting which stocks are going to do well and which stocks are going to do badly. And this is something that people mistake me for when I'm doing this kind of thing, when I'm doing this kind of work. People seem to believe that when I'm analyzing stocks, I'm trying to predict which stocks are going to do well, which stocks are going to do badly. Now, there's always a degree of speculation in what I'm doing, of course. but I am looking to put the odds in my favor of success. That does mean there are going to be some turnaround stocks like Rolls-Royce, where this company in 2020 lost 30%. And the year before that, they lost 9.4%. And the year before that, they lost 17.5%. And in 2016, they lost 30%. And when you're looking at a company like that, are you putting the odds in your favor if you're buying them? I don't think it's a wise decision. Now, it's turned out that if you took that massive risk, you got a massive reward. And that's fine. If that's your approach to investing, then that makes sense. Like, go for it, But for me, that's not my approach to investing. I am not going to take a risk on a stock like this in the hope that it turns around and does well. Now, there are going to be stocks that do turn around and do well, and I'm going to miss out on those. But you're going to have situations in life where you do everything right and the outcome isn't always what you're going to want it to be. There's going to be times where you do things wrong, and sometimes you'll pull it off somehow in some miraculous fashion. My point is that as an investor, I am trying to put the odds in my favor by analyzing companies, and I'm trying to essentially make the right decisions. Now, I'm going to be making the right decisions for me and my investing approach. And there are going to be cases, of course, where I make the right decision, but it doesn't work out for me. And it has happened. I've had a couple of stocks that haven't worked out for me, even though on paper everything looked really good. And then a war happens in Ukraine and Putin invades, and I can't foresee that happening, and the stock's been damaged as a result. And that's just something that happens from time to time. But I looked at Rolls-Royce in 2020 and I assessed it and decided this was too risky for me. And there was potential, like there is always potential for a stock to turn around, but you can't always pick them. So yeah, there are going to be companies that I look at that I think it's not right for me. But if you go back to any video that I've done, I've never said you should or shouldn't buy a stock. Not categorically in that way. I've never said you definitely need to buy this or you should definitely stay away from it. I've only expressed what I would have done. What I would have done on this particular company for my investment approach. And I share the data, I share the facts. And if you look at the facts and think, you know what, Chris wouldn't buy this, but I'm going to, then go for it. I've got no issues with that whatsoever. Like, go for it. But to come on here and say you said Rolls-Royce no good and look at how they've turned around, yeah, that's going to happen. There's nothing I can do about that. But I still feel like I made the right decision at the time with the information that I had in front of me. But if you're the sort of person that goes out there and takes a much bigger risk than that and it's paid off for you, great. But if I go out there and do that over and over again and buy all these companies in that way, taking massive risks, I'm going to get burnt. And I'm going to get burnt more times than I get paid out. I would much rather let a few slip through the net that I didn't manage to jump on, but have more successful trades than I have losing investments, if that makes sense. So that's the Rolls-Royce situation. We're going to come back to Rolls-Royce a bit later on in the show. I hope that makes sense. If you don't agree with that, that's totally cool. Like, couldn't give a monkeys if you don't agree with it, to be fair. But yeah, let me just see what was going on. Okay, Alex, you come onto somebody's live stream and you're just moaning. What's the point? Why are you coming on here for to do that? I don't get the point of that. Like, let me just work out, what do I have to do here? Because I'm just going to kick you off the chat, mate. What's the point? You gone? Like, what I don't understand is why you would spend time to come onto someone's live stream just to moan. If you invested in Rolls-Royce and did well, good for you, bro. Like, why do you feel the need to come on here and moan about it? Like, I don't understand. I think this is because of the culture of investing and the stock market world, where everybody is trying to compete with predictions. I don't predict. Like, there's speculation in everything I do, but I'm not the kind of person that's going to go around saying, I think this stock's going to be at this in... You never hear me say that. You'll never hear me say, oh, I think this stock's going to be at 17. Loads of people do that. I let them get on with it. There's no point in me doing that, because I have as much ability to predict a stock's share price in 5 years, 10 years time as anyone else does. You know, what I prefer to do is focus on the facts, focus on the stocks themselves. Yeah, I mean, I'm of the mindset here, guys, that if you don't like what I'm doing, don't tune in, and you're just going to get kicked off. I'm just going to kick you off. I've got no qualms with that at all. Yeah, let's get back to positivity. Good shout. Right. So I like I said, I look at the recovery periods of these downturns. This is what I wanted to show you. What you will notice on every single crash that has happened, they've recovered. And something that I think is quite important to take away is that, let's go back to that chart that we were looking at here. I want to bring it down to a monthly chart. This is the monthly chart of the S&P 500. You do not need to wait until it starts to go back up to do well. So what most people, in all these previous crashes that we've ever had on these markets, excuse me, in all these previous crashes that we've had, you could have sat on your hands and done nothing, and the markets would be back up to where they were pre-crash within a relatively short period of time. Not in every crash. Some crashes have taken longer to recover than others. But take a look at 2020. Okay, so it was February and March. It was the COVID time. The markets came crashing down. How long did it take before the markets got back to where they were pre-crash? Well, let's have a look. 1, 2, 3, 4. You can argue 4 or 5 months before the markets had fully recovered the downside of that crash. Now, you can argue this is a different crash to other crashes, sure, but you'll find this every time you look at a previous crash, okay? The amount of green bars it takes to get back to where it was will differ, but it gets back there. It's just a matter of time. And you could do nothing, sit on your hands, not invest in anything, and in that period of time, in 4 or 5 months in this particular crash, you would be back to where you were prior to it. Now, what I prefer to do in these situations is I buy every month, and I continue to buy every single month. What it means is that I don't have to wait as long for the markets to get back to where they were before I'm back in the situation that I was in prior to the loss, because I'm buying on the way down, I'm buying at the bottom, and I'm buying on the way back up. And as the price starts to go up, I'm making additional profit that I wouldn't have previously made, because I'm buying down here, I'm buying at the bottom, and I'm buying on the way back up. And so actually the price doesn't need to get back to where it was before I'm back into a position that I was in prior to the loss. By the time the market gets back to where it was in its pre-crash pricing, I've made a ton of profit out of that situation. And I want people to bear this in mind, because if you do this, if you go back to all the previous crashes that we've seen, this is one of the worst ones. This was a decline that took a number of years, and it took a while to get back to where it was. And then we had another decline, and it took a long time to get back to where it was. So we've got to bear these in mind. Sometimes they do take a long time to recover. But you can buy all the way down, buy at the bottom, and you don't need it to be back up here before you've made a profit on that situation. And I want to bear this in mind, because you can go onto the stock market, you can go onto, YouTube and wherever today, and everyone is talking about how it's the end of time. It's the end of the stock market. There are videos on YouTube right now saying this is the end. And it's clickbait material. It is people that are jumping on this opportunity to get clicks. But I'm not of that school of thought. I never have been. I look at these situations and I believe that these are opportunities for us. You've got to buy the right company. You've got to be doing your research and doing your analysis to find the right businesses. But I genuinely believe that this is a fantastic opportunity for people who know what they're doing, who know what stocks to invest in, who have done their analysis, who have done the research. I think this is an opportunity that we didn't have just a few weeks ago. And had the markets continued to climb, I would have been buying at higher prices. And I still would have been looking for deals. I still would have been looking for opportunities and bargains in terms of price. But now I've got 20% off the stocks that I was already going to buy. So I'm very, very bullish on the whole situation. Again, I'm not saying that the economy is not going to struggle. I'm not saying that the markets can't go down even further. I think they can. But yeah, I'm a optimistic investor here, because I already know what stocks I want to buy. We do our analysis on the 51 stocks that I've identified that I like, and I literally just sent out a pricing analysis to our clients today to talk about this and to show them what's changed, because the market is so volatile right now that these prices are changing much faster than what they would normally change, of course. And these prices coming down has now opened the door on a number of stocks that we've been watching for a long time. We've got stocks that we've been watching for over a year, 2 years, 3 years, that we've had our eye on, but have been overpriced for a long time. And you look at these companies and you look at the historical charts and you think to yourself, oh, we've got to wait. Like, will we ever see the price again that we want to see for this particular company? Will this company's price ever drop down to a level that we would be happy to buy them at? And every week we're checking and we're seeing, no, it's still too expensive. It's still too expensive. And then a crash like this happens, and suddenly the door for that particular stock opens. And then everybody thinks, well, I don't want to buy it because the market's crashed. and I'm thinking, no, this is what I've been waiting for. This is my opportunity to buy this company that I love the look of and have done for a long, 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 long time. And now I can get them at a price that makes sense to buy them at. And yeah, I like I say, I'm very bullish on the whole thing. Yeah. Hi, Steve. Hi, Neil. Yeah, I've kicked him out, Neil. He's gone, mate. Hi there, Christian. Tiago, how you doing, man? Lovely to see you, mate. Yeah, James, he's gone, mate. That's all good. Mark Gallagher. I pulled a large amount of cash out of Rolls-Royce at £1 a share. I also got it wrong. That's life. Yeah. I mean, I've invested in companies that went down as soon as I invested into them. As just part of life. You're right. Bobby, so confused why he was pissed. If he had, he was a winner. Exactly. Yeah. I think it's the culture of investing and the stock market that people have. They're automatic. When I first started trading and I started investing, I very quickly found this very competitive kind of chest pumping, banging sort of very male orientated, testosterone filled industry where everyone was trying to predict the stock market and compete with each other and bring each other down. And this is one reason why I ended up leaving Twitter, because Twitter was full back then, when it was Twitter, was full of people who were just ripping into each other's decision making, into their stock picks. When I used to run the FTSE show on YouTube, I don't know if any of you guys were ever following me back then when I was doing the FTSE show. My YouTube comments were full to the brim of people who, because I would pick out a company, I would do a YouTube video on that particular company, and they would jump in the comments and people would get upset with what I'd said. And I'd ask myself, why are they upset? Why are these people getting upset about the fact that I've shared the financial statements of this company and I didn't like what I saw? Why are they upset? Because if they truly believe in their investment, if they've done their analysis and they believe that what they are doing is right, why would you be upset with what I've got to say? Why? Why would you? I wouldn't go into somebody else's video and rip it apart. It's facts. I'm sharing facts. I'm sharing. At the end of it, my opinion is I don't like the numbers, but there's almost like people. I feel like people are looking for confirmation bias. They're looking for confirmation of the decision that they made was the right decision to make, which means they're not fully committed and confident about the decision that they've made. And again, I think it's this culture in the stock market that people assume that if you have an opinion on a stock, you're trying to predict that stock. And if you watch any of my past videos, you'll see that I'm very much a facts-based investor, very much a facts-based person. If you want, I am not interested in opinion. In fact, I'm reading news reports and I'm reading that the CEO of a company really thinks the company are going to do well next year. I couldn't give a monkey's what the CEO thinks, because it's an opinion. Show me the facts. Show me that revenue is climbing. Show me that the company are making 20% profit a year and then reinvesting that profit back into the business for sustained growth. Show me their growth strategy that they're going to employ over the next 5 years. That's what I'm interested in. If you send me a statement from the CEO saying he's very optimistic about the future of the company, I don't care. I've got no interest in that whatsoever. I'm interested in the facts. And if you look at what I've done over the years in terms of YouTube videos, in terms of the podcast, I'm always focusing on the factual information, because people don't need to hear my opinion on a stock. It's just, there's enough of that out there as far as I'm concerned. I don't feel like people need my voice on top of all the other voices out there that are saying this stock's great because I think it's going to do really well in the future. Okay, great. I'm glad you think that way, but I want to look at the facts, and that's my approach. So let's have a look at what people are saying in the chat. What are your top 5 stocks in this opportunity? I don't really have any. I have a list of 51 stocks that I've analysed every UK stock. I found 51 that tick all my boxes. Of those 51, right now, about 50% of them, because of this crash, about 50% of them are priced at a level that makes sense to buy them at. I already love them. For them to be in my 51 means that I love the company. I love what they're doing. They're ticking all my boxes. About half of those are priced at a level that makes sense to buy them at. I provide that data to a membership program, and so I don't want to devalue that for them. I share that information with them, and we all invest from the same hymn sheet, essentially. We're looking at this data, we're looking at the facts, and again, it's not opinion-based analysis. I'm not saying I like these companies because I think they're going to do really well in the future. I'm saying these are the companies that tick all the boxes in terms of what I'm expecting the financial statements to show me. We're looking at trends in profit growth. We're looking at return on shareholder equity. We're looking at debt levels. Are they biting off more debt than they can chew based on their profitability? We're looking at trends in terms of profit growth, in terms of sales growth, in terms of net worth of the business. And we want to look at all of these different aspects to try and paint a picture of where is this business going. And like I say, I've looked over 1,000 UK companies. It took me years to do that. And at the end of that process, I've got 51 stocks that tick all the boxes that I've been looking for. I have an algorithm that I do, that I've programmed, that I've created, that puts the same companies through the exact same process and scores them. And only 51 of them made the grade. And I share those 51 stocks with my clients. And I also do price and analysis on top of that. And the pricing says of these companies that we like, which ones are priced at level right now that makes sense to buy. And that works out about 50% of them at this stage, at this point in time. It might be slightly more than that now, depending on what's happened over the last couple of days. But yeah, it's a case of, I would say any company that is making 20% net profit, that is showing revenue growth, that has debt levels that are zero or well within what they can stomach based on their earnings power, that's showing net worth growth. You know, I want to see that a company are taking profit, reinvesting that profit back into their business. These companies typically are low dividend payers, because I've done a lot of analysis on dividends. First of all, I don't really think that dividends are going to make me as rich as I want to be. Secondly, I prefer a company that's not putting all their money into dividends to keep shareholders happy. I'd rather they keep that capital, reinvest it back in their business for growth, and the share price does the work for me rather than the dividends. And so, you know, these are metrics that I look for in companies, and if you can tick a load of those boxes, then you're doing pretty well from that point onwards. What do we think of Greg's shares? I like the FTSE show. Thank you very much. Yeah, we love Greg's. Greg's cool. I really like Greg's at the price as well. The price has come down quite considerably. I think that's a great stock. At 16, 17 pound a share. Yeah, great. ETS bought more Greg's today. Yeah, I mean, I bought a Greg's sausage roll the other day. So I've done my bit for you there. Your analysis is about the numbers. That's why I follow your facts over feelings about a certain company. I agree. I think there's enough feelings out there, to be fair. I prefer to see a lot more factual information on companies. Hey, you're live. I like your content. Thank you very much, ATR. Appreciate it, mate. I bought Greg's a week ago. Going to buy more this week. That's from Robert. Nice one, Robert. Yeah. Greg's is a very popular company in the chat right now, by the sounds of things, which is pretty cool. Les Simpson, you're right, Les. Nice to see you, mate. I quite like people pulling my stocks apart. I feel like I'm very plosive on this mic. Hopefully it's coming through okay and not too poppy. I might need to get like one of those pop shields or whatever. Chris C, which cool name. I quite like people pulling my stocks apart as long as it's factual. Seeing a bull case is easier than a bear case, I find, in most instances. Yeah. I think that if you've done your analysis on a company and you are confident in your decision making that you've made, somebody comes along and says, I wouldn't buy that stock, it wouldn't bother you. It wouldn't pull the rug from under your feet. I think if you're getting emotionally upset by somebody saying, well, I wouldn't buy that company, then perhaps you're not as confident in that company as you were. Again, if this guy, whoever his name was, I've forgotten his name already, was a buyer in Rolls-Royce, then he's done really well. Why would you be upset about somebody saying that it wasn't a great stock 5 years ago? Who knows? Is Games Workshop still in the bargain range? I've been wanting to purchase that company for a while. I love Games Workshop. I've actually got somewhere, I've got some Warhammer 40,000 stuff. I had these little Ultramarines. A friend of mine wanted me to play and bought me a load of stuff to try and get me to play, and we met up maybe twice in about 2 years. So yeah, we didn't get a chance to really play it, but yeah, I like the fact that they've got this deal going on with Amazon now, where they're looking to do some TV stuff as well, which I think is quite promising. At the moment, I think it is a bit overpriced, 120 odd quid a share, unfortunately, but it is a great stock. Ian cashed in on some premium bonds last week, waiting for the funds to clear to buy Greg's. I have had trouble with capital, in so much that I maxed out my stocks and shares ISA and in March, and I couldn't put any more in, and I had to wait until April the 6th, yesterday, to get the new tax year come through. And then obviously this happened and the markets crashed, and what an opportunity. what a great piece of timing for me, because I just transferred my money into my ISA as my 20k allowance reopened again fresh for the new tax year, and just so happened there's 20% sale on, so that's pretty cool. Chris, would you mind looking at the trade desk ticker TTD later on, please, mate? Interested to know your thoughts. Les, I'm going to be looking at 4 companies today, mate, that I've already put together some of the information for. But what we're going to be doing in future, if this goes well today, which I feel like it's going fairly well, if this goes well, then I'm going to be doing this every Monday at 8 o'clock. And thanks, Imran. And yeah, so what I'm probably going to do is we're going to have a Discord chat room in the actual Discord group where people can put requests in, and we're going to actually invite you guys to kind of shout out and request stocks that you want us to look at in the show. And as we go through a bit later on in today's show, you're going to see there's going to be a fun little aspect to that as well. So yeah, today, Les, probably not, mate, I'm afraid. But if you want to chuck that into the Discord, we'll do that, and we'll have a look at that. So and yeah, we'll look at any of the companies that people are asking to go through. We can probably do, I reckon, about 4 a show. So they should have enough time to do about 4 companies on a per show basis. So yeah, four a week's pretty good. Aaron Roberts, hi Chris, how long does it take to join the investment club? Interested in completing the application but yet to see a response. Hi Aaron, yeah, I saw that come through, bud, and it's a case of probably sitting down tomorrow and processing the applications that we've had in. So yeah, you should hear from me tomorrow on that, buddy. Malcolm, hi Chris, good show, love your podcast, cheers. Thank you, Malcolm, appreciate that, mate. Christian, very informative so far, Chris, love the podcast. Been in the investment club over a year now. Yes, of course. Nice to see you, buddy. Adrian, hey Chris, I asked if you could take a look at Ituran Location and Control, ITRN, if you haven't managed to take a look yet. Any chance you could have a scan tonight? As I mentioned, Adrian, I'm not going to be able to do that tonight, buddy, but if we put that into the Discord chat, there's a separate room, I think. Can we bring it up? Yeah, we've got a live show discussion room in here now. I don't know if you can see this. This is the problem. I need like 5 screens to make this work. But yeah, we've got in here, we have a live show discussion chat now. So if you join up to the Discord and jump in there and put your request in there, we'll do it. And that'll be awesome. Let me just have a look at the other comments. And ITRN are actually on my list. I have a whiteboard right over here that you cannot see, and it's huge, and it has a whole list of companies that people have asked for in the past that I'm slowly getting through. So you probably have asked that already before, hence why it's on my whiteboard, but I am going to get to it. So yeah, so where are we? Let me just quickly check my schedule. So in future episodes, what I want to do is we're going to look at some videos, watch some videos of latest news and stuff like that. But today I really wanted to just jump on and chat a little bit about, you know, what I'm planning on doing and this whole approach and, you know, future episodes, stuff like that. And I wanted to really just dedicate the first part of today's show on the crash that we're currently experiencing and going through, because like I said already, and I'm not going to repeat myself over and over, but I'm very optimistic about this situation. I look at all the previous crashes that we've been through, the fact that the markets have always recovered, and yes, the markets sometimes can take a long time to get back to where they were. We're talking a couple of years, and again, you know, we can look at this recovery process here and look at how long sometimes it's taken for the markets to recover, but they do recover. And if you are in this for the long term, I get people that they say to me, I'm a long-term investor, I'm in this for 10, 20 years, and then 6 months passed and they message me saying it's not really happened as quickly as I'd hoped. And I'm like, you said that you were in this for 10, 20 years, and 6 months later you're moaning. And you know, if you are a long-term investor and you are genuinely looking at a 10 to 12 to 20 year outlook on your investing, then you really have no worries, in my opinion. Looking at the crash right now, you could buy right now and you're going to do fine. Even, you know, you'll make plenty of money out of this situation, in my opinion. They say you should buy when others are fearful, or be greedy when others are fearful, and be fearful when others are greedy. And we have a fear greed index, which I think is pretty cool. And as you can see, the market is currently going through a state of extreme fear right now. And there is a historical chart somewhere. That's the crypto one. So this is the one I'm after. So this is a historical chart. It goes back to about a year ago now, and this is where we've been in terms of this fear greed index. And as you can see, there's been moments where we have dipped into extreme fear, but now we're well and truly into that point at this point in time. And I've read a heck of a lot of Warren Buffett books, and this is something that he's always been a massive advocate of, is to invest and to buy when others are fearful. Well, you cannot get more fearful, apparently, according to this fear greed index chart. So I think this is a great opportunity to buy. So that's where we're at right now. I want to look at some companies today. Before we do that, I'll just quickly check the chat again. Malcolm, any tips when a bunch of companies all enter cheap value at the same time? Do you buy the few that drop the most or bounce back first, or the company you rated or scored the highest, or never started position? I get what you're saying. Thanks, Malcolm. Yeah, I'm in that situation right now where I've just pumped a load of money into my stocks and shares ISA, and I am spoiled for choice. And you have the question then of, well, where does this money go? How do I divvy this up? If you have a broker where you're paying fees, it makes sense not to splice it up too much, because you're going to be paying fees on every single transaction. There are brokers out there like Trading 212 where the commission is free, but you're paying more in the spreads, and so they make their money somehow, if that makes sense. But you know, taking that out of the equation and trying to assess where does the money go, for me, it's always just come down to gut feel. It's come down to looking at my portfolio and looking at what do I love the most. That decision often comes down to what do I understand the most. And what I mean by that is, for example, I could have a company that make a product that is very simple to understand. They create a product, they produce it, they market it, and then they sell it. And it doesn't matter what that product is. Obviously it matters, but in terms of this analogy, it's a product that I can understand. There's always going to be a market for it, and I understand the business model. On the flip side, there are companies that tick all my boxes financially, that look like great companies, but perhaps they're like a pharmaceutical company and they're working on new drugs. I understand a traditional simple business better than I understand like a global pharmaceutical company with many different moving parts. And so often it comes down to, what do I understand better, tends to be where my money will go, because I'm not a massive fan of diversification. I think if you don't know what you're doing and you don't know how to pick between stocks, diversification is a safe bet. It's something that probably you should be doing. But when you have the knowledge and the kind of capacity to be able to pick between companies based on what you know and based on your ability to analyze companies, then I think it makes more sense for me to hone down on the companies I like the most. And the way Warren Buffett often puts it is, why would you invest your capital into your 21st favorite stock when you could put it in your top favorite stock? And if it's just in the interest of diversification, then fine. If that's, if you don't know how to pick the difference, then fine, diversify. And a lot of people should be doing that. That's why a lot of people that don't do any analysis should probably just be buying the S&P 500 or whatever. I would never recommend buying the FTSE 100, by the way. It just doesn't perform well enough to make any sense. Which is why I've got family members and people I know that have index trackers that have tracked the FTSE 100, and 10 years have passed and they've looked and seen what they've achieved, and it's like 1.7% return a year, and yeah, it's not great. So the S&P 500 is probably the best fund to invest in, because it performs way better than the FTSE does. And there are other funds as well, and you could do some research on funds, and there's ETFs and stuff like that. But yeah, when it comes down to actual individual stocks, I have a handful of stocks that I love, that I get, that I understand. And so if the opportunity comes up, like now, where my top 3 companies are, if any of my top 3 companies are priced at a level that makes sense to buy them at, I generally speaking will put money into them over anything else. There are stocks out there that I've kind of coveted for a while that I've never seen the price at the right level, and sometimes if I've got maybe if I've got like $3,000 to invest one month, then I might put 2 into my favorite company, but put 1 aside for the company that I've kind of just wanted to own a little bit of, but never got around to doing. But yeah, that's generally speaking how I would go through it. So hopefully that answers your question somewhat, even though it's not a black or white answer, I suppose. Mark says, can people please advise what Apple platform they're using for smaller share purchases? I'm currently using Hargreaves Lansdown, £12 per transaction, not worth buying unless it's 1k plus. Yeah, 100%. And so Trading 212 is a good option. They have, I believe it's no commission trading, so you don't have to pay anything, I believe. The downside to that is that the spreads are higher. And so, for example, if you were going to buy X stock and you could buy it at Hargreaves Lansdown for £10 a share, you're going to trade in 212 and it might be £10.20 a share. So that's how they'll make their cut on that, basically. Neil says, I use Trading 212, but it's not an ISA. Yeah, so again, AJ Bell, a bit cheaper. There's Interactive Investor. You'd have to shop around and have a look and see. But something that I massively rate is something called Grok AI. I go there all the time for any questions that I have. Because if you put into the Grok AI search and say, can you provide me with a list of stocks and share ISA providers that produce that charge less than £12 per transaction, it will produce you with a list, and it's pretty cool. Yeah, so that's it. So let's go into some stocks. We're going to do a little bit of analysis. 9 o'clock, so about an hour into the show, so it works out pretty nicely. I want to look at some companies today. Like I said, going forward, when we do these shows, if people are interested in us looking at particular companies, join the Discord. I can see people are coming into the Discord as we speak. Join the Discord and throw some stocks in there. And then every time that I'm prepping the show for Monday, we'll slowly make our way through the list, and you'll get your stock looked at. So the first one we're going to look at today is a company called Speedy Hire. Now, let me just make sure that you can see what I need you guys to be able to see. Yeah, we're good. As long as I scroll down as we go. Yeah, we should be good. All right, cool. Right. So, this is Speedy Hire. Speedy Hire are a hire and services company. They're engaged in tools and equipment hire services to the construction, infrastructure, and industrial markets. Its segment includes UK, Ireland, and corporate. That's pretty much what they do. And you probably seen Speedy Hire vans driving around and all sorts. Just going to take a quick swig of coffee. Keep me going. Right. So this here are the financial statements of Speedy Hire. This is something that I put together. And it has it all displayed in a way that I like, and breaks stuff down for me in a way that other financial statements don't. So, for example, just to kind of clear this up, the reason why I do this myself is because a lot of the actual financial statements will break down, as an example, the gain or loss that a company has made on the sale of some assets, right? Now, I'm particularly interested in that because I want to extract that out of their financial statements. I want to know what money came into a business that didn't come from the recurring everyday business that they run, but came from the sale of an asset. So it could be a subsidiary of the company or a recent acquisition they've decided to sell off, or it could be their whole American arm of their business has been sold. These are one-off events that bring in, usually but not always, profit, and from an accounting perspective it gets put into the profit for the year. And so a company can record wonderful profits, but these have been coloured by the sale of these assets. And so what I like to do is I like to take any gain or loss that's been made on the sale of an asset and separate it, so that I can then see, well, what's the underlying business actually achieved without this, by extracting this out. That gives me an insight that I need to be able to see, to be able to ascertain, am I happy where this business is going? Because next year they ain't going to be able to sell off that asset again. That's it. Once it's gone and been sold, it's gone. And a lot of people don't do that. A lot of companies that provide financial data don't separate it. Yet it's in the original financial statements. And so I have learned over the many years that I've been doing this now, over 10 years, a way that I like to do things, a way that I like to put the information in front of myself so that I can accurately find out the information I want to find. And so it takes a lot of work, takes a lot of data entry to take information from financial statements and plug it in. But it has to be done that way because the data providers out there, which often charge through the nose for their data, don't separate the key information that I need them to separate. And I've gone through this with many different providers and said to them, can you do this for me? So that when it comes through, it's already done and they can't do it, or they don't do it. And it's a real shame. So yeah, at the moment, still doing a lot of data entry and doing this myself, but it doesn't take that long. So, but looking at Speedy Hire, we've got a company here that in terms of sales, we've got up to the 31st of March 2024. So we're relatively up to date with the latest financial statements there. And we've obviously got the 31st of March coming out probably in the next few weeks, probably maybe a couple of months before that will actually see the light of day. We tend to have to wait about 2 months after the end of the financial statements for the annual report to be typed up and made to look nice before they release it. So that's probably going to be a couple of months away before we see that. But in terms of sales growth, there is some sales growth here. It's not amazing, but we've gone from sort of 400 million down to 300. That's to be expected based on the situation that we found ourselves in, and many businesses have found themselves in 2021, 2022. And then we've seen in the last couple of years sales have increased, but where things have, I mean, this is a company that hasn't really made a lot of profit. If we come all the way down here to the net profits along this bottom line here, you can see relatively small percentages from Speedy Hire, making 2.7% profit in 2017, 3.6, 5.4, 3.4. This isn't a sort of company where they're making enough profit. And the way I like to analogize this is that if you were making a certain amount of income and you are only keeping 2, 3, 4% of your income to then use to reinvest in yourself, to grow yourself, which is something that we should all be doing, in my opinion. When it comes down to personal finances, we should be running ourselves in the same way as the companies I like to invest in. That's how I know that it's a company that tick my boxes, that is a company that I'd like to invest in, because they are keeping enough surplus cash and they're making enough profit that they've got enough to reinvest back in that business to grow the business effectively. And it's the same with us. Having read many different I've got a ton of wealth books up here. They all say the same thing. You only really need to read one of them, and the concept is essentially you need to spend less than you earn, and you need to have enough surplus left over at the end of the month to be able to reinvest in yourself so that you can grow your income further. That's the basic kind of system to wealth growth, personal wealth growth. And then you grow your income, but you're still keeping 10-20% every year, and you make more income and you still keep 10-20%, and you use that money and it just gets fed back in, and you create this money making machine. I want to see that in a stock, and I'm not seeing that with Speedy Hire. They don't quite make enough. Now, I respect any company that's making a profit. I think it's great. I'm a massive, I'm very hopeful for UK business. I want to see UK businesses do well. I never enjoy seeing a company doing badly. And Speedy Hire are making 3, 4, 5% a year. They're doing all right until the last couple of years. 2023, they made a loss of 1.2%. Now, they reported a £1.2 million profit, but they received 6.6 million in other income that needed to be extracted out of the everyday business. And this is what I'm talking about. They get these big waves of profit that come in that have nothing to do with what they're actually doing as a business. It's just a one-off. So I have to extract that. And so they reported 1.2 million in actual profits, but if we extract that, the underlying business it made a £5.4 million loss. And so again that happened in 2024. They made 2.9 million from an extraneous income source, but actually if we were to take that off, then they actually made a 200k loss. So the last couple of years, the underlying business has not been doing particularly well, and it's been disguised by them posting profitable years when actually it hasn't really been. It has officially been a profitable year from an accounting perspective, but the actual underlying business not done so well. And so that's largely, as you can probably see from the statements, been attributed to a massive increase in expenditures. The selling, general and admin expenses have gone up from 185 million to 211 million, and again nearly 212 million. So we're looking at 96% of their gross profit or gross margin has been spent on expenses, and that's a bit higher than what they've been in the past. So that's knocked them back a little bit, unfortunately. I always like to look at net worth as well, the net worth of the business. So we're taking the assets of the company, we're taking away the liabilities, and then seeing what's left in the company. Now, another aspect that's caused this reduction in profitability is the line here, line number 18, interest expenses, which have gone up considerably. Now, as soon as you see that on an income statement, it tells you one thing: they're borrowing more money. And we can find that out by going to the balance sheet, looking at the non-current liabilities, and we can see right away this figure here. So this is a company that went from 44 million to 68 million to 92 million to 104 million in debt. And so they're borrowing all this extra money, but obviously you know that when you take on extra debt, you've got to pay back more in interest, and that's what they've been doing. The amount that they're paying in interest has brought them down now to a point where they're not profitable, and that's a concern, because you've got a company that's taking on more debt that's going to make them unprofitable. And this is like a personal individual who's taking on credit card debt, and the repayments are eating up the surplus that they've got left over at the end of the month. And so they can't grow, they can't do anything. And this is the problem that Speedy Hire have currently got. And as a result of that, we're now seeing net assets dropping. The net value and the net worth of the company has gone from 221 million down to up to 226, but then down to 185. And then in the last year, down to 175. So this is a company that's shrinking. It's now down to the level it was back in 2016 in terms of net worth of the company. So yeah, movement in the wrong direction. They're not buying back any shares. They can't really afford to buy back shares. They have done so in the past a couple of times, excuse me, but in the last year they didn't buy back any shares. And yeah, it's a company that is now trading at 29 pence a share, and it's been falling quite considerably. If we take a look at was it SDY? Yeah, there we go. So, I mean, this is what we will tend to see when share prices are going to go down, when you see the profitability of a company decline. Essentially, you're going to see a drop in share price. Not always, but yeah, this is quite typical to see when a company start posting poor financial results. We're going to start to see a decline. This decline's actually been going on since 2021. So, at today's price, we're now at 19. We're now at 19 pence. Crikey, that's changed quite a bit since I looked at this. But yeah, so 19 pence a share. We can take, when we want to price up a company, there's tend to be two strong ways we can do that. We can look at the earnings power of a company and look at what kind of percentage return we're receiving in terms of earnings. For this particular company, they're making an EPS, an earnings per share, of less than a penny by the looks of things. So it works about 3%. That's not great. That suggests that 19 pence is too expensive, unfortunately. But then on a net worth basis, we're looking at a decent deal here, because if you take the net worth of the company, the net assets at 175 million, and divide that up by the number of shares in circulation, which is 517, then you're getting about 34 pence in value per share, and it's priced at 19. So in that respect, this would be a no-brainer for Speedy Hire, basically. But from an earnings perspective, on a per share basis, it's not earning anything. And so you've got to be really careful with a company like that, because yes, in terms of value of the company, you're getting a good deal, but it's lost its earnings power. And at the moment, because of those debt levels, there doesn't seem to be a company that are moving in the right direction. It seems like a company moving in the wrong direction in terms of earnings, because they're taking on more debt, they're paying more interest. That's only going to hamper their ability to make profit in the future. And could this be, you know, a running theme now for a while? How are they going to pay down that debt if they're not making any profit? And so if this earnings power is gone, how are they going to grow their net worth? Because to grow your net worth, you need profit to be able to reinvest in the business to grow the business. So you might be buying a bargain from a net worth point of view on a per share basis, but it might not go anywhere now. And this is why the share price is so low at 19 pence, because investors are looking at this and they're not really seeing anything in here that would suggest the share price could potentially, you know, grow and do particularly well. Let's have a quick look at the chat, see what's going on, because I've neglected you guys for a little while. We're still talking about ISAs, which is fairly cool. Benjamin, could you check Clinica Bavaria, or do you only check UK business? So I have just started moving into US businesses. We recently took a look at Porsche, or Porsche, I don't know how you say it. I always used to call it Porsche. But if you look at what I do, it's very much UK based, and that's where I've focused all my efforts, because I'm obviously UK based. But we've started to look at US businesses. So far I've looked at, I think we're at 82 companies now that I've analysed from the US. We've found 9 that we like, of which only 1 is priced at a level that makes sense to buy. The German thing was almost like a favour for a friend, so it wasn't really something that we're going to be ready to really go into at this stage, just US. I'm not really sure who Clinica Bavaria are or what country they come from, Ben. But if you join the Discord and chuck them in there, as long as I can read the financial statements of a company, I can take a look. It needs to be, and I typically have found this to be the case because I've looked at a couple of Norwegian stocks and stuff, it needs to be broken down from an accounting perspective in a similar way to UK, US companies. So if their accounting procedure is very different and alien to me, I'm not going to be able to really understand it properly. But if they are presenting their accounts in a similar sort of fashion, then there's no reason why I can't break it down and take a look. And I am inquisitive enough to want to know. So if you chuck them into the chat and I can do it, then I'll take a look, because I love finding new businesses. It's one of my favorite things to do. Is I'll sit here on a Monday, on a Tuesday, I do it on a Thursday as well, where I'll sit here and I just spend my time digging through companies. I love it. It's one of my favorite things to do, because there's nothing greater than the feeling of finding a company that tickle your boxes and that you didn't know about before, especially if it's a company you never heard of. And you suddenly think, wow, this company are doing great, they're ticking all my boxes. Then you do the pricing analysis and they make sense in terms of price as well. There's nothing more exciting, in my opinion. So, Spanish. Okay, cool. So my son speaks Spanish. He might be able to help me. I don't speak Spanish, so we'll see. But chuck them in and I'll have a look. If you can join the Discord, put them in the chat, and I'll take a look at them. Hi Chris, like you were saying about buying your 21st best property, would you ever consider stricter criteria and reducing your watch list down to 20 or 25 or so? Yeah, I get what you're saying, Satnam. Thanks for your question, mate. Would I reduce it down to 20 or 25? I don't really see the need to, because what I'm doing is I'm producing a criteria of 51 companies. Of those 51, only probably 50% are priced at a level that makes sense to buy them at. And then I'm producing that information, all factual, to our members. And our members are then looking at those companies. I also produce a 8 to 9 page PDF breakdown on the entire history of that company, what they do, where their edges, why they're so successful, what's making them so successful, what their strategy is for growth, all that kind of stuff. And I leave it down to then our members to then go through and work out what they resonate with, what companies that they like the look of, that they, and it's going to differ between different investors. Certain people like certain types of stocks, certain people are from backgrounds. We've got members who are from a pharmaceutical background that understand it a lot more than I do. And so they'll look at the same list of companies, but perhaps they'll resonate with that pharmaceutical company. And so I get what you're saying in terms of I could increase the threshold to reduce the number that are there, but it feels like a sweet spot. It feels like there isn't a strong reason for me to probably really do that. I like the fact that we have, about 50 stocks that are sitting there, that are about 20 to 25 of them are priced at a level that makes sense, and we'll sit there and go through them and pick our favorites individually based on our own personal preferences, I suppose. To narrow that down even further, I get it would help in terms of indecisiveness and perhaps kind of pushing people towards making decisions. But yeah, I'm not really sure that's of massive value personally. iClinics want to increase clinics from 120 to 180. Oh, this is Clinica Bavaria. Okay, cool. Okay. Yeah, I mean, any company that want to grow, great. That's a good sign. So, Speedy Hire. We're looking at a company that are not making enough profit for me. This is not a company that I would personally be interested in. They're not making enough surplus cash to be able to reinvest back into that business. I'm interested to know what you guys think. I mean, you guys are now looking at the data in front of you here. We've gone through it together. This company with quite significant debt in terms of 104 million, but their profitability is, well, they made a financial loss last year. So they've got to find a way to pay down that debt. What do you think of this company? I mean, for me, it's not something that I'd personally be interested in. 19 pence a share, I can see why people might be interested in. There's a degree of certain investors out there that just want bargains. And when you look at this from a net worth point of view, you're getting a bargain because you're buying a stock that's got, if they were to sell all their assets, pay down all the liabilities, there would be 34 pence per share left over to be spread amongst shareholders, and you can buy it at 19. So in that respect, it's a no-brainer. But my concern is that they're not profitable at the moment, and the lack of profitability means they're going to struggle to grow. What does that mean? That the share price is no longer going to go much higher than where it is now? That would be my concern with this particular stock. But yeah, Speedy Hire, not one for me personally. You guys may feel differently, but this is how I feel about this particular company. We're going to take a look at, let's dive into Rolls-Royce, our old friend. Let's take a look. How did you compile the table of financial results for the last few years? Manually. How did you compile the table of financial results? How did I get this data? Yeah, manually. There are services out there, but they don't provide it in the format that I need it for my personal analysis approach. And so I have dabbled and tried so many different providers of financial data out there, and they don't produce it in the way that I want it. And I've just given up trying. I even looked at one last week and started downloading the information, and it was such a mess. The information was, some of it was inaccurate, some of it wasn't even right. And I downloaded the information, married it up against my figures, and thought, why are their figures different? I've then brought up the financial statements of these companies, the actual financial statements that produced by the companies, and my data is correct and their data was wrong. I thought, what on earth are people paying for? So yeah, I just do it manually, and it's I've got a team of people that help me out with this as well, doing the data entry for me, and so it makes it manageable. But it's an ongoing, constant process. When a company release their financial statements, it's a case of jumping on that, inputting them into the spreadsheets, bringing a company up to date. It doesn't take very long, and as long as we're on that constantly, then it works. So Royal Mail, Royal Mail. We're not looking at Royal Mail. We're looking at Rolls-Royce. Royal Mail are a whole nother kettle of fish. Yeah, Rolls-Royce. I did a video, as you probably know, if you watched the show earlier, probably 2020, 2021, and I wasn't a fan. And you can probably see why I probably wasn't a fan. This is a company that back then they had revenue sales of 15.7 billion, then 16.5, and then in 2020 fell to 11.8. Now we all know what happened in 2020, so you have to take that into account and bear that in mind. But this is a company that were hemorrhaging money. They were losing, and it wasn't just a sudden thing. They lost money in 2014, they lost money in 2015, in 2016. 2017 was a better year, but then they lost, and we're talking big money as well, 17.5% loss made in 2018, 10% lost almost in 2019, nearly 30% lost in 2020. This is a company that when I'm looking at them, I'm thinking, no, I'm not a fan of a company that's hemorrhaging money in this way. Now, since then, things have changed. Rolls-Royce have been a massive turnaround stock. They've been huge. And I believe this was largely due to the small nuclear reactor work that they have been doing and weren't doing back in 2019, 2020, as far as I'm aware. And so that's been a massive turnaround point for this particular company. Now, you could have bought Rolls-Royce at cheapest chips in 2020, but it would have been a massive risk because back then you didn't know that Royal Mail, for Christ's sake, Royal Mail, Rolls-Royce. I need to have the screen up so I can make sure I don't keep calling it the wrong thing. You could have taken a risk on Rolls-Royce at a cheap price, and if you did, it would have paid off and you would have made mega bucks. But it's a big risk, big reward. That's often the way it works, and I'm not a massive risk taker. So I would much prefer to put my eggs in the basket of companies that are delivering in a profitable point of view. They're growing, they're doing the right things, rather than a big risky strategy where I'm investing in companies that are hemorrhaging money in the hope that they turn it around. Now, you will get companies that you invest in, if you invest in that way, that pay you out. And maybe the payout offsets all of the ones that didn't. In my experience, that's not usually the case. If you have an investing approach where you are taking massive risks, buying into failing companies that are hemorrhaging money, and you're doing that consistently, even if you get a couple of winners, they generally turn out not to pay out all your losses because you've been doing it for so long. And so it's just not a company that I was interested in back then, but they've definitely turned things around. And you look at the revenue of this company, it's gone from 11.2 to 13.5 to 16.5 to nearly 19 billion now as of 2024's data. So yeah, a massive turnaround, and it's been fantastic. And I'm really pleased for Rolls-Royce. I think they're doing great. They're now a company that are making 12% profit a year. That's great. And so they're undoing a lot of the damage that has been going on with Rolls-Royce. And when I mean damage, I'm talking about things like the net worth of the business, because even today in 2024, this is a company still in negative equity. So if we look down here at the net assets value, so 2018, they were worth minus $1 billion. By 2022, minus $6 billion. In negative equity. So again, another reason why I wouldn't be particularly interested in this company is because the assets of the company were at 29.4 billion, but the liabilities came to 35.4 billion. Meaning, if you were to sell all the assets, liquidate all the assets into cash, then use that cash to pay off your liabilities, you would be short by 6 billion. So not what you want to see in a company, especially when it's going in the wrong direction. -1, -3, -5, -6. This is all going in the wrong direction. Now, because they've now turned things around and started to become a lot more profitable. I mean, we're looking at profit coming in of 2.2 billion a year. They're now in a position where they're able to take that profit, reinvest it back in the business, and undo that damage. And they're slowly doing that. I say slowly, they're doing it pretty damn quickly. In what year was that? 2022, minus 6 billion, now only minus 0.8 billion in just 2 years. So that's quite considerable turnaround. And this is something that you would want to factor in when it comes to pricing, because right now it might not look like a great deal on a pricing perspective, but if you're forecasting where might this company be in the future, well, if they continued to improve their net worth at that rate for the next few years, then you could expect them to probably be at positive 5 billion in net worth in just maybe 2 more years, maybe 3 more years. So you would want to factor that in perhaps when it comes to, am I getting a good price? Maybe not now, but in 2 or 3 years time, if they continue to grow at the rate that they've been growing the last couple of years, maybe the price today is a good price, and we'll come to that in a moment. Then they've stopped buying back their own shares, although I think there was some news that just came out that they're looking back into starting to do share buybacks, which share buybacks are something that I like. Share buybacks are essentially where a company will take some of its profit and they'll use it to buy back shares from shareholders. And in doing so, what they're doing is they are reducing the number of shares that are in circulation out there. And by doing that, they are therefore improving the value of the company, of the shares that are still in circulation. So if you're a shareholder in this company and the company are buying back shares, then the fewer and fewer in circulation, which means your slice of the pie is slowly getting a little bit bigger. And then the market generally will reflect that in so much that the share price will probably go up a little bit as a result of that, because the shares are now worth a bit more. And sometimes that's lagged and it takes a bit of time to come through to fruition, but it's generally a positive thing. But buying back shares tends to be almost, for me, it's a bit like a last resort in terms of ways to add shareholder value. If you're buying back shares, it's usually because you've kind of exhausted other options in terms of expansion of the business and stuff like that. So you tend to find the bigger companies are the ones that they're struggling to grow, and so they're trying to work out, well, how do we add shareholder value here? Or maybe we buy back some of our shares from shareholders and increase their slice of the pie that way and make their shares a little bit more valuable. But they're not doing that at the moment because they really haven't been able to afford to do so. And really, they've got a lot of repair work to do on this company before they're going to be in a position to do that. I think there was some news that maybe they're looking at buying back something like maybe 200 million, but maybe I'm wrong. I may have misread that. But they've got, it's an improvement. There's definitely a turnaround. The share price of this stock now is at £6.40 the last time I checked. Let me just bring them up and we'll take a quick look. Rolls-Royce, here we go. So yeah, we've seen a bit of decline, as you can expect. Many stocks have done the same, but we're at £6.36 a share. And you can see where this has been. And I mean, we're on the hype train right now with this particular stock. So the question is it worth £6.36 a share? Is it worth it? That's a real difficult question to answer, but we're going to try. So the earnings per share of this company, its current profitability is about 30 pence a share. So if you're buying this at about £6, it's about £6.36, wasn't it? Let's update this slightly. So £6.36 a share. There are 8.5 billion shares in circulation. So the earnings per share works out about 30 pence, 29.87. You're getting about 4.7% then on earnings. Now, obviously, you don't get that 4.7% as a shareholder, but what we're doing is if you were to buy all 8.5 billion shares in Rolls-Royce at £6.36 a share, and all the profit that it was making was now yours to keep, you didn't have to divide it amongst any other shareholders, it was just yours, you'd be getting about 4.7% return. It's not great. It's not brilliant. We would want more than that in terms of, you know, what would make a good investment. What that tells us then as an investor is that the asking price is too high, because the asking price needs to come down for that to look like a better deal for us. We want a better percentage than 4.7%. So the share price needs to come down, which tells us therefore that the share price, the asking price on the market today at £6.36 is too high. It's not right. The net worth, we can't judge this on its net worth. It's in a negative net worth right now. It's at minus 781 million in terms of its equity. So we divide that up on a per share basis, you've got less than zero. And so you're buying a company at £6.36 a share and the net asset value is minus 9 pence. Now, on face value, therefore, that would suggest that it's a terrible deal. But like I said before, we want to be factoring in future growth into that. Not always. I personally am the kind of investor that likes to get a deal now. So I like to invest in companies where from day one it's a no-brainer. You know, I can buy a company. I want to buy a company that it's going to cost me £1 a share to buy it, and it's worth £1 a share from day one. So it's only going to improve. So I'll always have bought it at £1, but in 10 years' time it might be worth £4 or £5 a share for the stock, and I'm just winning at that point. And that's the kind of company I like. With Rolls-Royce, you're starting off in a deficit. It's not worth £6.36 a share right now, but it could be in the future. And so you're getting in at this point overpaying. You're definitely overpaying for this stock right now in the hope that its growth continues and eventually it is worth £6.36 a share and more. And that's what you're hoping for. The signs suggest that it could get there. But then the question is, well, what would it need to be worth for £6.36 to be a decent price? Well, at the moment, we could put in, I don't know, let's say the net asset of the value of the company is 5 billion. Well, then we could break that up on a per share basis. It would work because the number of shares in circulation is 8.5 billion. It would be worth about 59p. So that still wouldn't be good enough. It still wouldn't justify spending £6.36 a share. It would be a price to book ratio of about 11. That's too high. So again, it's too expensive. So if it was worth 10 billion in net worth, would that be right? You'd be getting £1.18 a share in net worth value and paying £6.36. closer, but still too high. And so really, I think if we're going to hit on 15 here, probably hit it right. Yeah. So we're getting a price to book of 3.6. That's more like it. It's still not amazing, but it's more like it. You know, you'd be like, okay, I'm getting £1.77 of value per share. I'm buying them at £6.36. It's not awful. That's okay. But for that to happen, this company have got to be worth 15 billion in net worth. So based on its trajectory at the moment, how long would it take them to get to 15 billion? Well, they're making about 2.3 billion in profitability per year. So assuming the vast majority of that 2.3 billion is going to be reinvested back into the company, then it's probably going to take them about 5, 6, 7 years to get there. So you're buying this company at £6.36 in the hope that in 5, 6, 7 years, the company will eventually be worth £6.36. That to me means that I think the share price is too expensive, personally. I think £6.36 is too high. I think that the stock is suffering from hype. I think people have jumped on this. It's been a recovery stock. Everyone that got in at £1 a share has done wonderfully well out of this particular company. It's gone from £1 to £8, now falling down to £6. They've still done really well. But I think what's happening here is that investors are seeing this and they want they want a slice of the pie. They want a bit of the excitement. And that's what creates a hype train. I think that's what's going on here. I think people, even at this reduced price, they're still overpaying for this particular company. But it is popular. I get it. I think a lot of people are into this particular stock. Let's take a look at the chat quickly. Prawn. Gutted I missed the start of this. Is this being recorded? It's not, but we are going to be splitting some bits up of it. It is being recorded, but it's going to be cut up and some of it's going to be put on YouTube and stuff like that. So the vast majority of it you'll probably see in segments on my YouTube channel at some point. Satnam, that's a good point. Probably better to have 51 companies to choose from where markets are up. Nearly out of juice from my phone. Great live stream. Hope it continues for the future. That's awesome. Thank you so much. I am hoping people have been enjoying this show. It's something that I think I'd like to carry on doing on a Monday once a week. I think it lends itself well to a once a week show. So yeah, I think I probably will continue with it if there is interest there and people want to tune in and check it out. But yeah, what are your thoughts on Rolls-Royce, guys? Let me know in the chat what you think of this particular stock. Would you buy this company at £6.36? Or do you think this is too expensive to buy? I'd like to hear your thoughts on what you think based on this data and what you can see here. So let me know in the chat if you're on, and let me know what you think about Rolls-Royce. We're going to take a look at 2 more companies before we wrap up for the day. I'm going to take a look at Vollex Group, or Vollex PLC, not Vollex Group, Vollex PLC. They make, it says the sector is electronic instruments. I'm going to bring them up very quickly, actually, and just take a look and see what Hargreaves Lansdown says about them in terms of what they do. So they are engaged in integrated manufacturing, oh God, of performance critical applications and power and data connectivity solutions. I am none the wiser. The company's portfolio of products, capabilities and solutions include, power cords, plugs, connectors, receptacles, integrated manufacturing services, electric vehicle charging solutions, consumer cable harnesses. So data transfer cables, electric vehicle charging components. So we've got a pretty good idea what's going on there now. So Vollex. So this is a company that are doing all right over the last 7 years. The average profitability of this company runs at about 4% a year. So a little bit lower than what I'd look for, but they're doing okay. They're ticking boxes. They're making profit. It's consistent. They've been doing it now for 7 years on the trot. Last losing year was 2017. So 7 years in a row now where they've made profit. That's good. Revenue growth is clearly there. We can see that this company that's grown from 300 million all the way to 900 million. And in fact, 2024 was quite a big jump. That's a revenue growth of 26% in 1 year. So that's a big old jump for them. But it hasn't improved profitability. Why is that? So the cost of sales also went up as the revenue went up. So gross profit did climb from 157 to 200 million, but they've lost more money in the selling, general and admin expenses, which has eaten up even more of that cash. And so even though revenue went from 723 million to 913 million, the actual operating profit after you deducted cost of sales and the general expenses of running the business means they only made an extra kind of 10 million in the end. So they've lost a big chunk of all those extra sales in the cost of just doing business, unfortunately, which is a shame. On top of that, as you can see here, we saw this was, I think it was Speedy Hire. The interest that they're paying on debt has tripled. It's gone from 5 million to 15 million. So when we go down to the balance sheet, we're probably going to see an increase in carried debt, which is going to offset any additional profit that they're going to be making is going to be eaten up by that unfortunate growth in interest that they're paying on debt, unfortunately. And so, you know, last year, 2023, or the year before last year, they made 5%. In 2024, they made 4%. Even though revenue went up so high, the profitability of the company stayed roughly around that 4% mark, unfortunately. Looking then at the net assets of the business, is the net worth of this company growing? Is the business getting larger in terms of its assets minus its liabilities? And the answer to that is yes. It's a company that probably from, let's have a look, 2012 all the way up to 2018, if we look at this figure here, they didn't grow. They were sitting at 50 million net worth. They kind of fluctuated here and there, but they kind of stayed around that figure. And then in 2019, they went to 115 million, 130, 180, 200, 230, and now 330 million in net worth. So this is a growing stock. This is a company, a business that is growing, is doing well. Its assets are climbing. So we've gone from 150 million to, is that right? Crikey, 839 million in net assets. So the assets of the business are growing substantially fast, doing very well there. Of course, as you would expect, liabilities are also growing from 100 million to 500 million, but they're not growing at faster rate as the assets are. Hence why we're seeing the net assets climbing, which is great. Debt has gone up as we expected because of that rise on interest on debt. We would expect to see the debt levels actually going up, hence why the interest is rising. Obviously, interest rates have been rising as well, but if it's going to rise by the times by sort of 150% or whatever it was, 200%, then the interest rates haven't risen that high. And so it must be an increase on borrowed cash, and that's certainly what we're seeing. We've gone from a company that had no debt whatsoever in 2020 up to 150 million now. So then we ask ourselves the question, well, is that something we should be concerned about? The 150 million of debt outstanding, is that too much? And for me, based on what I like to see in a company, it's right on the cusp. We've got a company here that's making about 35 million a year. That's their earnings capability. That probably will go up in the future, but as it stands right now, they're making that kind of money. And they've got 143 million in outstanding debts. Is that too much? Well, I just tend to look at the ratio of net earnings, the profitability of the company, ratioed against that debt. And it works out about 4 years. So, in other words, if they were to take all of their profit and use that to pay down the debt, it would take them 4 years to do so. And I'm happy with that. 4 years is all right. It's right on the cusp of what I'm looking for. But I wouldn't be concerned. It wouldn't be a deal breaker for me on this particular stock. If debt levels went up much more and profitability didn't, then I'd start to be a little bit concerned about that debt level. but at the moment it's kind of at manageable levels. So yeah, we've got retained earnings going up. Retained earnings are kind of like a pot of savings, if you will. It's not actual cash that they can call upon. To do that, we would have to look at the cash and cash equivalents. That's the money that's in the bank. That's 29.8 million. They got 29.8 million sitting in the bank as cash. But the retained earnings are like accumulative. So every year, it will identify how much money they're pumping into the business and have done and have been, and it's a kind of climbing figure, and it's quite a useful figure to check to see whether or not the company is growing, and it's gone from 90 million to 211 million, so that's really good. We're liking that. CapEx levels, the money that they're spending on capital expenditure is a bit high. So over the last 10 years, the company that have made in total net profit 150 million, but they spent 100 million on capital expenditures. So that's a lot. So it's a CapEx heavy company. They have to invest a lot of their money on expenditures on things like property, plant and equipment and stuff like that for the business. And you can see here they spent nearly 100 million in the last year just on property, plant and equipment. So it's quite a heavy CapEx company. But yeah, it's not a company I personally would invest in, and there's a couple of reasons for that. The main reason being the lack of profitability. Again, we're talking about 4% net profit. If you on your personal finances were only keeping 4% of your income as cash to be able to then reinvest back into your future growth, it wouldn't give you a lot of power. It wouldn't give you a lot of options and capabilities to expand what you're already at. And so I want a company that's making 10, 20% and can reinvest that 10 or 20% back into their business to grow, to open new stores, to create new products, to do more research and development, to expand into new geographical territories, that sort of thing. With 4%, you're very limited to how you can grow. Now, this company are growing their sales. They are doing a good job of growing the sales despite only making, smaller amount of profit. But that might not be sustainable. They may not be able to continue to do that. This may have been, who knows? And you'd have to read the annual reports to identify why. Why did sales jump so high? What was it that caused that? Was it something that was designed? Was it something that they engineered? Or was it just circumstance? Was it just something that just happened because they're in the right place at the right time? And you can use that information to then try and ascertain, is this growth going to continue then based on what we know about that growth? And when I'm doing this, I'm not looking at the annual reports. I'm not reading the annual reports in fine detail. So I don't have that information. I don't have that data, that kind of commentary or story behind it. What I tend to do is I look at companies in this fashion. This is what I call my stage one analysis. And then if the company tick all my boxes, I will then invest the time to really read down into the annual reports. This company don't tick all my boxes, unfortunately. And so I'm not going to spend my time reading all the annual reports because I've got enough work cut out for me reading the annual reports of 51 companies that it's about efficiency of time. It's like a triage system, if you will. The company have to be worth me looking into, if that makes sense. Otherwise, you've got 1,000 companies out there. You just can't look at them all. It's impossible. So I don't know the backstory as to why revenue has jumped up, from 600 to 900 million in just 2 years. It's impressive. It's fantastic. They're doing that despite only making an average over the last 4 years of about 5% net profit, which is impressive. But it's still not a company personally that I would be buying myself. But it's not a bad stock. If you owned Vollex already, I wouldn't be like, you need to sell that. Like it's doing all right. It's not too bad. Share price £2.37 a share. So is that a good price? Well, I would say yes. Because right now you're getting an earnings per share. They've got 184 shares in circulation. This is why we have to check the number of shares that are in circulation. Because it's wildly different from company to company. We were looking at Rolls-Royce earlier, and they had, what was it, 3 billion? Was it 3 billion shares in circulation? This is a company with only 184. So you're dividing the profit up against far fewer shares, which means the earnings that they're making on a per share basis is going to be, vastly different. And so you have to break down these numbers. You have to really dig down to understand, what are you getting for your share? If you buy one share, what are you getting for that one share of £2.37? Well, you're getting, in terms of profitability, even though you don't get to take that profit and put it in your pocket, you're getting 21 pence per share. So if you're buying them at £2.37, and again, the way we would analogize this, if you were to buy all 184 million shares in this company at £2.37 per share, all that profit would be yours. You haven't got to share that with any other shareholders because you're the sole owner of the company. So you would be getting 21 pence per share in profit, which works out 9%. Now, any investment, you can take your capital and invest it in something and receive 9% a year in return. That's a good investment. There aren't many investments out there where you can get 9% a year. And bear in mind that the original price you paid for it stays the same. So in years to come, as the profitability increases and the earnings per share increases, you'll be getting 9%, but maybe next year you'll be getting 10%, and you'll be getting 12%, 15% eventually if the company continues to grow. And so I like companies where, and investments where you are getting a great return in terms of the profitability from day one, because it's only going to get better if the company are a growing, profitable business. And you're getting a good deal there. So for me, that indicates that £2.37, good price. We like that. Again, the other way that you can look at the price of a company is looking at the net worth. What are you getting in terms of underlying business? And the way, again, I analogize this to help people understand it is like if you were investing in a house. Well, profitability is like the rent that you would receive if you had a rental property that you had invested in. So you'd be receiving rent, but the house itself and the land that it sits on would have a value that's yours as well, because you own the house, right? And you own the land. So you've got the underlying equity of the value of the house and the land, but it's also generating you a profit. Great investment in that case. And we love investments like that because we're hoping that the underlying value of the house and the land appreciates in value over time whilst it's generating you with some sort of income. Fantastic investment. And so we look at this in the same way. A stock is an asset like any other. And so unlike, gold, crypto, maybe art, whiskey, jewelry, these are things that have the appreciation in value but don't provide any sort of income. Whereas things like a farm, you could buy a farm would have the land and the property on it, and it would appreciate in value, hopefully. And also the produce that it grows on the farm or whatever activities the farm is used for, hopefully can generate some sort of income for you. So it's a much better investment in that respect. And that's the kind of investments that I'm into. That's what I like to see. So we can look at this from the profitability point of view to ascertain whether or not the share price is a good value, but we can also look at it from an underlying net worth. The value of the business itself. How do we do that? Again, we look at the assets that the company owns and what the values are of all these things. So this is what the balance sheet is. We've got the cash, we've got the inventory that's currently in existence and what the value of that inventory is at cash value, at cost value. We've got income tax. So this is income tax assets. So this is probably offset against what they've got to pay, perhaps. We've got net receivables. This is invoices that are yet to be paid to them, but the money's on its way. So again, it's got a cash value, and it's something that they can liquidate and turn into cash if they wanted to. And there's all these different things. We've got non-current assets, so any assets that are harder to liquidate and would take longer than a year to do so, typically. So you've got property, plant, equipment, such as vehicles and machinery and stuff like that. We've got intangible assets, we've got long-term investments, we've got deferred taxes, we've got assets that are held for sale, and many other financial assets that the company has. And it works out that this company, Vollex, have assets worth £839 million. And then we offset that against all of the liabilities, the debts, the invoices that it itself needs to pay other people. And we can offset all those liabilities, and works out that we've got a net asset value of £335 million. If we've got £335 million worth of equity, of net worth, and we're going to divide that up by the number of shares in circulation, which is 185 million, then it means that per share, we're getting £1.82 in value. And we're only having to pay £2.37 a share for it. So it's a price to book ratio of 1.3. That's great. That's really good. So we can buy a share for £2.37. Immediately from day one, it's worth 1.82 in underlying value, plus 21 pence per share in profit. And then factor in that if this company keeps growing and keeps moving in the right direction in the way they have been, then probably what will eventually happen is the underlying value of this business will be worth more than what you paid for it. That's a great investment. That's a great deal. And so when we're looking at pricing and the business itself, or the stock in the investment itself, they're two separate things. You could have a terrible company at a great price. Would you buy it? Just because you're getting a good price doesn't necessarily mean it's a good investment, because the underlying business, the underlying investment itself might be awful, might be a terrible company. On the flip side, you can have a wonderful business, but the price isn't right. Would you buy it? And this is where I look for a company that I love, that tick all my boxes, that I really want to own, and the share price makes sense. I need a combination of the two as an investor. Now, there are many, many different ways to invest. There are many different ways to approach investing. Some people trade short-term markets. Some people like to do crypto. Some people buy bargain stocks no matter how rubbish the underlying business is. If they're getting a good deal on price, they'll buy the stock and they'll hope that it just is worth more in 20 years' time. It's like buying a piece of gold and hoping that it appreciates in value over time, regardless of the fact that it can't produce any sort of profit or income. That's just not my style. It's not what I'm into. Doesn't mean you can't do it, but it's not what I do. So Vollex looking all right. I would say pricing's good, but the performance of the business just isn't quite strong enough for me to be interested as an investor, when I know that there are companies out there delivering 20% net profit a year and the pricing's good. My money's always going to go to that than to a company like Vollex. But it's not bad. And if you really love the company and what they did, I could understand why you might invest in this particular company. Let's take a look at the chat. Dun, 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 dun. Good first live stream, Chris. Time to wind down. Early start, the long day tomorrow. Yeah, it is getting late. Thank you very much for joining me. You've probably gone already, but thanks for coming. Thanks for supporting my first ever live stream. It's the first time I've ever done this, so I'm chuffed that it's gone relatively well from a technology point of view as well. Like, nothing's broken. I'm amazed that that's happened. Les, really enjoyed this. Thanks, Chris. Time to call it a night for me. Let's hope the bear market continues for a little while yet so we can all enjoy the sale. Thank you, Les. Thanks for coming along, mate. Satnam, with Greg's, their share price has been dropping since September 2024, which was way before this crash or correction. Is there anything you're aware of for this strange but near 50% drop in high quality? Excuse me. So not really. You are absolutely right. The share price started to go down long before all of this kicked off, and that is often a cause for concern for investors. But you have to check to see whether or not it's correlated to any actual... This is what I do anyway. I like to see whether or not it's actually correlated to any business event and business performance, because as far as I'm aware, it wasn't. I would need to refresh my memory on that, because it's been a little while since I've looked at Greg's. But the best way to do that is you'll know when the financial reports are coming out. So unless it was timed at the same time as a financial report, then you could look at news articles and look at, okay, did something happen, or did a statement come out from Greg's that would warrant this? If nothing, then it can often be something completely unrelated. we've actually seen prices falling for a while across many watchlist stocks, and yet performance has been fantastic. And actually, I did a little report on this to our members quite recently, where we were talking about the very fact that prices had all come down across most of the watch list, and we're talking about the 51 stocks that I've identified, and yet every week we're reporting on the news from those particular companies, and all of the news was positive. Record revenues, increases on profit from 24 to 20 compared to 2023. This was all positive news, and yet share prices were down like 15%. And sometimes it can be a factor of investors expecting more, and so a lot of beginners, when they first start investing, they don't understand this concept where good news can come out but share price can go down, and they say, well, the news was good though, why would the share price go down? And it's because the market were expecting better. And it's hard to know what the market sentiment is. It's hard to know what the market were expecting. Sometimes you can find that information out. Sometimes it is there is like a market expectation that the company have addressed and identified in their annual report, and they said, we're hoping to achieve this. That then becomes the market expectation. If they deliver under that, then that sometimes can affect the price negatively, even though the news is still positive. And you can also get the flip side of that. So you can get bad news come out and the share price goes up. And people say, well, how does that happen? Well, that's because the market were expecting it to be way worse. And it's improved. It's not as bad news as what they were expecting it to be. And so the share price goes up. And so, there's that aspect to be factored in as well. Where I like to focus my attention is on how is the company performing. News can come out and you can read the news and it can have an impact on the share price, and it usually does because we're humans and humans react with emotion. But where I focus my attention when it comes to investing in stocks is how is the company performing? That's all I care about. And, even in this situation now, share prices have plummeted 20%. How are companies doing? How are companies performing? Are they delivering? Because if they're delivering, I'm still going to invest in these companies at 20% off, knowing that I'm probably just going to do really well out of that particular company because I'm getting 20% off, because I'm getting in on the cheap and the underlying business is performing. They're doing great. Now we have to factor in what impact are these tariffs going to have on some of these companies. That might be why investor sentiment about that particular stock has gone down. But we also should factor in the concept that maybe these tariffs won't be around. There is that factor to consider, in so much that is this just a bargaining chip that Donald Trump is using to try and get people to adjust their tariffs against the US? Is this a bargaining chip to bring people to the table? And if so, maybe this is a short-term thing. If that is the case, we may see the markets rebound relatively quickly once tariffs start getting changed back to, more reasonable levels. But still, my thought process, my mindset is always on company performance. How is the underlying business doing? Are they making profit? That's all I care about. The rest is noise, and that's tend to be how I tend to cut through that noise, is looking at businesses, the underlying business themselves. Yes, Labour government increased minimum wages, increased national insurance contributions for companies. Love the company products, but this government is crippling UK companies. Yeah, to a certain extent. I don't think it's crippling UK companies. Not so much, not from what I've seen in terms of annual reports in the businesses, because what tends to happen, and I don't know if the government are aware of this, if they were aware of it ahead of time, I mean. But if you read the annual reports of all these companies, and bear in mind I read the annual reports of all 51 of my companies on my watch list, so I read a lot of annual reports. These companies are taking those national insurance contributions and they're just passing them straight on to their consumers. So if you've got a company that's direct to customer, the customers are bearing the brunt of it by price increases. If it's business to business, the other businesses are bearing the brunt of it. All they're going to do is increase their prices, and that's exactly what they've been doing. So, and you can read this in any annual report that you read, you'll see them address the fact that, yes, we're aware of the national insurance contributions and they're going to have an impact on our business, but we're confident about the future because we've passed this cost on to our clients, our customers. And so the end consumer ends up paying for it. Yes, the company have got bigger expenditures, but they increase their prices to offset that, so it doesn't affect their profitability. And so there are concerns about national insurance affecting UK business, and I can't speak for all UK business. I certainly can't speak for smaller, independent, high street businesses who perhaps are being hit harder. It's very easy for a company that are making billions in revenue to absorb these additional costs. The national insurance cost that they've incurred is insignificant compared to a tax increase that they might receive or a slight increase in expenditure that year. So what these companies always tend to do, because they can afford to do so, is they just increase their prices and they offset it in that way. So yeah, it's there was a lot of worry about the national insurance impact on UK business, and my experience from reading the annual reports of these companies is that it's not really hit them that hard because they've passed that cost on. Yeah, thank you, Les. So I'm not fully in the front of my mind. I can't remember exactly what Greg's was saying about their results, but that makes perfect sense. And you'll probably read the report more recently than I have. When you read hundreds of annual reports from different companies, it's hard to remember exactly what everyone said. You have to refresh your memory sometimes. So it's just gone 7 minutes past 10. I am going to look at one more company, and then I think we're going to wrap it up for the day for the first test stream. So thank you to those that are still with me. But we're going to look at one more company, then we're going to wrap it up. And I'll have a think about I'll get some feedback from people in the Discord over the next week or so about what aspects of the live stream they enjoyed, which aspects perhaps were a bit dull, perhaps, and some recommendations in terms of what they'd like to see perhaps on these shows, so that we're not just doing the same sort of stuff every single week. I'd like to do some more fun aspects as well, which would be quite cool. We haven't really had time for that, but we're going to look at YouGov as the final company to look at today. So YouGov are an international online research data and analytics company, and you often see their surveys and the results of their surveys being used in the press. They do a lot of data analysis, essentially. So essentially what they do is they take data, they absorb data, they process that data, and then they share it with the world. And I'm not entirely clued up on how they make revenue, but I presume that they charge businesses and they charge media for access to this cutting edge data that perhaps is very useful for telling certain stories and painting a certain picture or certain situations. So I guess there is a revenue model there that they're using. But in terms of revenue, they're doing very well. They're growing quite nicely. In 2017, 100 million. By 2020, up to 150 million. Now up to 335 million just in the last 5 years. So they've over doubled in the last 5 years. That's quite substantial growth in a period where growth hasn't really been very widespread amongst many businesses. So YouGov bucked the trend there. They've certainly been able to find ways to sell more data, if you will, over those last 5 years, which with all the events that have been going on, perhaps they've capitalized on those events by creating data and sharing that data in some way. However, this has to be taken in context with the costs that have also increased. This was a company that back in, let's say, 2017, when they were making 100 million, were spending 90% of that on their costs of running their business, essentially, or 90% of their gross profit, I should say. And it's been sitting just shy of about 90%, 85 to 95% a year. And then last year, for some reason, it kind of went wonky. And if we look at the company from 2020 to 2023, it was looking pretty good, to be fair. It was 6% profit, 7% profit, then 8% profit, and then 13% profit in 2023. That's progress, that's growth. That's moving in the right direction. And as of July 2023, you could be sitting there thinking, I like this. It's going in the right direction. There's some real growth in sales. Then 2024 comes along, and the costs of running the business just soar. So the sales go up tremendously. There's great growth there, but the cost of doing business goes up to 96% of their gross profit. From 160 million to 260 million. So where's that extra million come from? Now, there might be an acquisition in there. There may be something else going on in there that you'd only know from reading the annual reports. And this is just the first layer. This is just the icing. You're just looking to see, is this company ticking all my boxes? If it is, I'm going to spend more time reading through the annual reports, really getting to know this business. You can't do that with every company. If you're one person like me, you can't do it with everyone. So you have to really pick your battles. And so I don't know is the where I'm getting at in terms of why costs of doing business soared from 160 to 260 million in just 1 year. We've also seen a relatively decent jump in interest being paid on debt. So it'll be interesting to see in the balance sheet whether or not the actual debt levels have increased. Again, that could indicate some sort of acquisition, maybe where they've borrowed money to pay for an acquisition, a takeover. In which case increased revenue, but maybe costs have gone up as well because they've now got this extra business to pay for. But I'm speculating without knowing the facts on that. So it's just what could be the case. But whatever's happened, it's caused them to become unprofitable. And that is the bottom line. That's why it's called the bottom line. It's the bottom line of the income statement, and it's how much money did they make, whether they made an acquisition or not and bought in another company. It's led them to be unprofitable. But what we would want to factor in is, are these costs like a one-off? Are we going to get back to where they were before in 2025, 2026, 2027? Or is this now part of the course? This is where we're going to be. Are YouGov now no longer a profitable company going forward? So that's something that you'd have to do some research and try and find out what's going on. Looking at the net worth of the company, the net assets of this business, it hasn't really climbed. And that would indicate no acquisition. Because if you're acquiring another company, that company is going to have assets, is going to have liabilities. And you would expect, if you're paying hundreds of millions for a company and acquiring them, that's got to add value to your balance sheet. Whatever that company's bringing, it must be bringing assets. It'll probably bring liabilities with it as well. But it should hopefully bring something to the table that's going to increase the value of the business. So that the business is if you're going to pay 100 million, you would expect the value of your business after the acquisition to be worth an extra 100 million on top of what you were worth before the acquisition. So the fact that net worth has gone down means perhaps there is no acquisition. Who knows? But you can see here they've taken out 169 million of debt. And this was a company that until 2024 had never touched debt. Again, that would lead me to think maybe there is an acquisition on the table of some kind. But again, we'd have to read the annual reports to find out. But the facts are that they've taken on a heck of a lot more debt and they're now unprofitable. So is that one-off, or is this part of the course now? That's something that would be my first thing I'd want to know. I'd want to know why. Why is that? What does it mean for the future? Does this mean that YouGov are no longer something we'd be wasting our time with? Because prior to that, in 2023, things were looking pretty good, not bad at all. So yeah, net worth of the business, it has grown. It's been growing. It's doing pretty well. It's gone from 90 million in 2018, now double that, 180 million in 2024. So it's a growing business. It's going in the right direction. It's just 2024's year massively hampered by an increase in costs and debt. So why is that? That's what we want to know. But looking at pricing, the shares are costing us £2.87 a share. There are 117 million shares in circulation. Obviously, because they made a loss in 2024, we're getting no profit out of this business at this point in time. If they were making the 13%, how do I get that up? Can I view and then do that and then click on that? Oh, okay, so I would just need to put in 31 EPS. Then there's a big bargain. So if they were making the profitability that they were making in 2023, 34.6 million, for £2.87 a share, we'd be getting 31 pence per share in earnings, in profitability. You'd be getting nearly 11% a year in profit. So prior to 2024, whatever happened, whatever caused those costs to come in, if you were looking at this company in 2023, £2.87 would have been a bargain. We would have been really happy with that. So then it comes down to the question, as an investor, will they get back to 2023's levels, or has whatever happened in 2024 mean that's not going to be likely? And that's what we would want to find out as a potential investor in this particular company. Looking at net asset value of the company, or net worth of the business, like we have been doing, 183 million. There's 117 shares in circulation. You get £1.57 per share. That's a price to book ratio of 1.8. That's pretty good. So that question is now becoming quite pivotal in terms of, would I want to invest in YouGov? Why have costs gone up? Why have they taken on loads more debt? Is this something that's going to affect profitability going forward? It will, because the profitability of this company, the debts that they've taken on, they're not going to get paid off that quickly. 170 million. Okay, we've reduced our profitability as a company, so that's reduced our ability to pay that debt off as quickly as we would have been able to had we not taken it on. We're now paying an interest on debt on top of that, so that's going to eat into our profitability as well. And that interest on debt's going to be there for years to come now, until that debt is paid down. A debt that we can't pay down unless we're profitable. Does that make sense? So it's one of these situations. I like to find companies that are acquiring businesses through self-sustained means. What I mean by that is a company that are making enough profit consistently over time that they build up their reserves, and they use those reserves to acquire businesses, so they don't have to take on debt. They don't take on the interest that they have to pay on debt, therefore not affecting future profits, future profitability of the company. And if their acquisitions are clever acquisitions, if they're solid, profitable businesses that they're acquiring, all they're going to be doing is adding to their profitability as a company, because the new acquisitions add in more profitability to the wider group. That's what I want to say. This isn't what it looks like it's happening here with YouGov. We've got increasing expenditures. We've got increased debt. That debt has now reduced their ability to make profit to pay off that debt. That's a concern for me. And so I'd be worried now that YouGov may take a number of years to get back to being as profitable as we would like them to be. So yeah, a little bit of a concern for me. It's decent from a net worth point of view. You're getting £1.57 per share in value. But will that increase? Will the net worth be able to increase now over the next 5-10 years if they're not profitable? So yeah, it makes that question of understanding why it's gone up key. And if I was going to really consider looking at YouGov as a potential investment, that's the first thing I would be doing, is opening up the annual reports to ascertain why, what's going on, what have they done, and what does that mean? What does that mean going forward for this particular company? Heavy on CapEx. CapEx is capital expenditures. So they've made 104 million in profit, but they've spent 136 million in capital expenditures. So that means that they're very CapEx heavy business. It looks to me like that's going to be less property, plant and equipment, which, as you can see, is the case. There's a data business, so it's going to be intangibles. They're going to be buying up licenses, rights, access to data, probably. And that's what makes up the vast majority of their assets, to be fair, is this intangible assets. I'm not a big fan of investing in companies whose assets are intangible, or the vast majority of assets are intangible. I'm a bit old-fashioned. I like companies that have got property, land, Machinery, not so much, because it depreciates in value pretty quickly, like a car would. So I'm not so keen on that. But certainly land and real estate, that sort of thing. I'm quite keen on companies that have a lot of that, rather than digital assets, intangible assets, assets you can't hold on to. Because my fear is that the pricing of those, the valuation of digital assets, can fluctuate very quickly. And I've seen this happen with businesses where they've released their annual reports, and all of a sudden the net worth of the business has dropped considerably because they've done a review of their assets and they've decided that these digital assets, they're not quite worth what we thought they were worth. And it's like, wow, that can happen just in a year. They can just suddenly drop out a ton of their net value. Whereas when you're dealing with a company whose assets are largely made up of tangible assets, property, land, real estate, that sort of thing, inventory, cash in the bank, these are things that don't tend to fluctuate in value quite so much, and they hold and retain the value, if not appreciate in value over time. And so I like companies that have a lot of physical assets that are something that we can rely upon going up in value over time. So not so much machinery and stuff like that, but more property and stuff. Digital assets, I'm just not so keen on it. So for me, this would be a business that would put me off. The profitability is a concern. I'd want to investigate that to find out what's going on there. For me, probably though, it's just not strong enough. I like companies that are making a lot more profit than this, but they're okay. And if you own this stock, again, it's one of those companies where I'd think, if nothing untoward was going on with those increasing costs, if this was something that was going to resolve itself in the following years, I'd say hold on to it, see where it goes. But for me, it's not something that, if you weren't involved in it, I wouldn't start getting into it now. I would probably stay away from it, purely because I am fully aware that there are far better opportunities out there. You know, when you are putting something like this in front of yourself, when you know there's a company out there that's delivering 20% is in a much better shape, why would you put your money into YouGov when you can put it into this? So that's the only reason, really, is I know there's better opportunities out there, basically. Just taking a last look at the chat. We've got no more messages in, so I think we're getting quite late into the day at 20 past 10. I'm going to wrap it up. For those that are still with us, thank you so much for being a supporter of what I'm doing. I hope that this has been useful and been interesting to a certain extent. If you're not part of the Discord, please come and join the Discord and be part of it. I'll put a link in the chat. I'll send an email went out today to everybody with a link to the Discord. So come and be part of it. Come and let me know what you liked about the show, what you didn't like about the show. I want to tailor it. I want to probably make it a bit more fun. There's some fun aspects I want to do. I am quite keen on the concept of an idea where we look at these companies, we vote on these companies, we put the votes in a hat, we spin a wheel, and I have to invest in some of these companies because I've got some play money that I would like to perhaps create a new portfolio where you guys pick basically the companies that I invest in through this. It'll be small amounts of money. We're talking maybe 250 quid a month that I'll put into a trade account, and I want you guys, the chat, to pick the companies that we invest in. And the way I kind of see it working is, if we look at 4 companies every single week, I will pick one, and I'll get you guys to chat to pick one, and we'll put those 2 companies, or one if they're both the same, if they turn out to be the same, we'll put 1 or 2 of those companies into a pot, and once a month we'll have probably about anything from sort of 4 to 8 companies being added per month to a wheel, to a spinning wheel. And I've started playing with this today, although I haven't really quite worked it all out yet. But we've got the spinning wheel thing here, and we'll put all the companies in here and we'll just spin it. And once a month, whatever it lands on, I'll buy 250 quid's worth, put it into a portfolio, and we'll just track and see how it does. I think that would be fun. I think that'd be a laugh. I think it'd be interesting to see what happens and where it goes. And it's just a bit of fun, really, just something to do, something to get you guys involved in things. And it's part of a story as well, like telling a story about, you know, how is the portfolio going? Are we doing terribly badly, or is it actually making money? Is that dog turd stock that we really didn't like that you guys made me buy actually turning out to be great? You know, that sort of thing. So I quite like the idea of that, but there might be loads of other ideas that we can do on the show that kind of break up the analysis, break up telling the news or discussing what's going on in the news, and creating a kind of more kind of varied show, I suppose. But thank you so much for tuning in, guys. I really appreciate it. There's still a few of you left by the looks of things, so that's awesome. Yeah, I will be looking at doing this every Monday at 8 p.m. Maybe 8 till 10 if 3 hours is too long. Depends if people feel like it's too long a show. I think we'll spend the next week to kind of digest what people's feedback is, and then we can adjust it and we can do whatever people actually want to see. Thanks so much, guys. I'm gonna run away now and go chill for the rest of the night. But my send-off message, I suppose, from today: one, thank you so much for your support and coming out and turning out to join me for my first ever live stream. I really appreciate it. And secondly, don't be afraid of what's going on in the markets right now, because this really is an opportunity, and every downside in history has recovered. But you don't have to wait for the bottom. That's my big takeaway. You don't have to wait for it to hit the bottom before you start getting in, because everyone will. Everyone's asking the question, how low can this go? When's the bottom going to come? It doesn't matter, because if the bottom, let's say we're looking at an individual stock, let's say the bottom is £3 a share. Well, let's say it's at 7 now, and it can go down to 6, it'll go down to 5, it'll hit 4, eventually come to 3, and then it'll start going back up again. The vast majority of investors wait for it to hit 3, then they see it hits 4, then they see it hits 5, then maybe they start thinking, do I get in? And they start, and then it hits 6, and they think, yeah, this is the recovery. It's starting. I'm getting in. I'm buying at 6. You buy 100 shares at 6. I would have bought at 7, 6, 5, 4, 3, and then 4, 5, 6 again. And I would have accumulated all these shares way cheaper than the person that started again at 6. Do you see what I'm saying here? Is that don't wait for the recovery to come. You can buy on the way down. Buying at 6 on the way down is the same as buying on 6 on the way back up. The stock market doesn't care what date it was you bought it. It cares what price you bought it at. That's what you should care about. It's all about price. What price you getting? Are you getting a good price on that particular investment? If the deal makes sense, then go for it. It's like any asset. If you're crunching the property that you want to buy and the deal makes sense, it's a good return on your investment, and it's going to be a good return for years to come, and the numbers all line up and make sense, go for it. Stop worrying about what the market might be doing, what the noise is surrounding the markets, because we know that the markets have always recovered after these big drops. And so this really is an opportunity for all of us, and that's kind of what I wanted to finish up on. So thank you so much, guys. I really appreciate your support, and I'll see you guys hopefully next week, but certainly during the week. Hit me up in the Discord and let's chat and see if we can refine this kind of live stream and make it better as we go. Signing off. Thanks, guys. Really appreciate it.